Hey Wizard, so the upgrades that have been worked on over the past year are about to hit, and the changes are significant. So I wanted to push this video out now ahead of time as a heads up for what to expect, and also just a crash course in how to navigate the new site. So currently today, if you log on to Crypto Wizards, you'll see this. You'll be familiar with this layout already. You have some pre-scanned items here, and then you can go and do some in-depth backtesting analysis, or more in-depth analysis on that pair for pairs trading or research or whatever it is you want to use it for. This is how it looks today. And you'll see that there's a lot more data here. And also, if I just very quickly jump into more in-depth analysis, there's a lot more that you can see that can be analyzed here when it comes to looking at a pair in depth. So I'm going to talk through, again, crash course style, what all of this is. More guides are to come, more video tutorials are to come. But for now, this is, again, just a high-level crash course. So this is what you will see when you log onto the site from next week, Monday, the 13th of Jan, 2025. You will see this new platform. But currently, if you log on today, this is what you will see here. So what I'm going to do here is just reset everything to restore it to factory settings. So get rid of any playing around that I've done. And this will replicate what you will see when you first log into the site, or when you first click on the zscore app. So when you first click on zscore to use the zscore tool, you will be met with this window. And so what this is doing is just checking your country, because since we first built Crypto Wizards, exchanges are now blocking certain countries. Now, I can confirm using a VPN will solve that issue for you, but I can't recommend that you do that, and I'm not telling you to do that. However, this menu will come up and it'll say, okay, here's a bunch of exchanges, and here is your current access to them. Which is your preferred exchange? Don't worry about which one you select, because you can very quickly and easily change this. In fact, you can just change it on the fly as you analyze things, but at least it gives you an idea of what it is that you are connected to. Now, you'll note that I have DYDX here. I'm in the UK, so it says I need a VPN connection to use DYDX, which is true. But again, I can't recommend that you do that. So this one here is grayed out, the rest is showing. You'll also note that there's not really more decentralized exchanges here. I have the same exchanges as before. And this is probably the only thing which has remained consistent with the older platform. And the reason for that is because the data with the newer and decentralized exchanges just isn't there. It's not there yet. If it was there, I would absolutely have included it. But the data we need for accurate or reliable analysis isn't there. So we have to rely on finding pairs through these exchanges and then using whatever platforms, I'll talk about that in subsequent videos, to go and either trade them or whatever you're doing with the data, do your research. So here I'm just going to select Binance for now. And when I do that, I get all these pre-scanned opportunities for Binance. If I want to change that, I can just go and select a different exchange here. Now, you'll note if I select DYDX, it goes orange, meaning that, hey, there's an issue with the connection of DYDX. I'll still be able to see the pre-scanned data because this is a snapshot in time that Crypto Wizards has done for you. But if I want to refresh that data, you'll see it doesn't change. The numbers don't change because that connection isn't working. Now, if I go back to, for example, Binance, and I go and refresh that, you'll see that that works absolutely fine. Again, so I'd need a VPN if my country is blocked for that exchange. So that brings me to a starting point for this. We have a settings here where you can go and update your preferences. One of the things I can go and do is go over here to preferences, change in any backtesting transaction cost that I want assumed in any time I hit refresh, or do I want it to automatically refresh every time I click on a pre-scanned opportunity? I can select that to auto. And when I come out of this, every time I click on an opportunity, it's going to refresh that data to the very latest data as of right now. So it will go and do that for me without having to click this refresh button. But if you're doing some research, you don't really always want that on because it takes a second to go and get that data, analyze that data and everything. So you might want to just leave this as manual. And so when you do that, everything's much snappier. You'll notice it's very, very instant and much quicker to sort through looking for spread patterns and all of that sort of thing. So once you find a spread pattern you like or some data you like, then you can perhaps go and hit refresh. Now, you'll also notice the section here on the right. It contains a lot of other information, as does this top bar over here. So let's talk about all the new data and information that's coming to the platform. Because right now, today, when you log in, if you go to the scanner and you click on an item, you'll be met with these charts. And then if you want more info, you can click on this chart here and go and do your analysis. But this is also very limited. There's been a lot more that's been added. And I'm going to say this right now. For those of you who are very glued to a particular way of analyzing this data, you're probably going to find the upgrades at first annoying because everything has changed. But then once you realize what you have, I think you're going to find it, you're just going to wonder how you did without this info. So just expect that there's going to be a bit of an adjustment to go through. And I think when we make upgrades this significant, that we can't get past that. So just bear that in mind. We've tried to keep the look and the feel of everything as similar as possible, but to also cram in like 10 times more data points and information and analysis, all of that. So just bear that in mind. Now, what is all of this information that's coming? Well, first of all, let's talk about this spread in general. So the spread is really the difference between these two prices analyzed in a certain way. So it's some kind of linear process that we are calculating that tells us how the relationship between these two assets is changing over time. And therefore, a pairs trader goes ahead and trades that based on certain statistical properties that have changed. And this is known as statistical arbitrage. So we have this spread over here. Now, before we had the static spread and the dynamic spread. The dynamic spread was calculated using a Kalman filter. It still is, although that Kalman filter has now been vastly improved. So the static spread and how it's calculated has changed, but it's using a new and improved Kalman filter for calculating that. But you'll also notice that we have this OU, also known as the Ornstein-Uhlenbeck process. And I haven't covered that yet on the channel. I will be. But just note, this is yet another type of spread as well, or way that you can calculate the spread. So there's now 3 different methods, and there's a lot of advantages to this OU process. I would go ahead and say this is a new and improved, empirically improved method for calculating a spread process, which has now been built into the platform. But you'll also note, other than the spreads, there's also now another strategy here as well, which is the Copula-based strategy. And we talked about Copulas in the previous video on Crypto Wizards. And so this is a completely different statistical arbitrage strategy. So I can go and select that as well. And maybe I'll just go and analyze something here for you. But this is a scatter plot of that copula and its dependency relationship. So I'll come back to that in just a moment, but let's go back to our scanner here for now. So I'm going to get rid of that custom analysis. For now, I'm jumping ahead of myself, but just note, these are all our different pre-scanned opportunities that we can filter by. And you'll also notice we have spread and z-score. What does spread mean? Well, spread, you'll notice the scale on the axis has now changed. It's been normalized so that it has a standard deviation of 1 and a mean of 0, meaning that the numbers for the spread are going to be consistent for every spread that you look at. So it's almost like, well, it is a z-score, but with no rolling window. That's how the spread is now presented. And you'll notice here I also have this z-score spread, and the z-score is the rolling version. So just to sort of try to keep naming consistent with how I had it before on the platform, this is the rolling z-score, and this here is just a normalized spread, or what I should actually call the z-score, but not rolling. However, that's the terminology that we're sticking with for now, just so that it's not completely confusing for people that are jumping from the older platform. So what does all that mean? Well, that might mean, and I'm going to just go here and draw my chart, it might mean that you want a strategy where you're, for example, buying down here and selling up here, or shorting up here and closing your short down here. That's just trading the spread. But if I click on here, the rolling z-score, and I just get rid of my drawings over there, you can see this is different. This is now where you're trading the up and down movements of that spread itself. And so this is exactly how you've seen it before. That hasn't really changed. But you'll notice that the z-score is not automatically showing here because the strategy I have is not a rolling z-score one. If I go up here to say a z-score strategy and I select an item, because it knows that you're looking at that strategy, it will automatically populate that here on the chart for you. So for example, let's actually refresh this data so I know I have the latest. You can see here that the spread z-score, or the spread's current value, is negative 2.03. And that is, I'm just going to get rid of that number there for a second, 2.03. That's this number here. And the rolling z-score is 1.06. So if I show that here, There it is, 1.06. So that's what this part here is telling you. Now, we have some dependency analysis here as well. The first thing is this profile tick. This is something we had on an older version, took it away, and now I've brought it back because from more of the papers that I've gone through, it is a useful piece of analysis to have. What this means is when crypto wizards say, let's say we take 400 assets on Binance and we analyze the data for all of them, we can see whether what's known as their eigenvectors and their eigenvalues show some kind of similarity. This is almost like seeing if certain cryptos are in the same industry. And so we know from trading stocks, for example, that stocks within the same industry tend to perform better for certain statistical arbitrage types of analysis or techniques. But how do you do that for crypto, really? And so using this approach, by running this clustering analysis on all that data, we can see whether there is some kind of match there. And that match is done based on their returns and their volatility between their high and their low. And this was actually a technique recommended by Hudson and Thames. You guys know I always go on about Hudson and Thames. So thank you, Hudson and Thames, for all the info you put out there, because that was really useful. Now here we have some Copula analysis. This is telling me for X, now X is CRV USDT and Y is ZIL USDT. It tells you here on the chart. So X is the blue one, Y is the pinkish reddy one. It's telling me that for X, being where it is priced right now, given where Y is, that the conditional probability of that is 97.5%. And the conditional probability of Y being where it is in price based on where X's price is 9.9%. So if I change my Copula filter here from any to arbitrage, it will tell me where pairs pre-scanned are within a range that presents an arbitrage opportunity. Now here's one I've just refreshed that's still showing an arbitrage opportunity. You'll notice here, if I go and refresh this one here, it's not any longer an arbitrage opportunity. If I refresh this one here, in other words, both of these aren't still green. But then if I come to this one here and it's refreshed, you'll see they're both still green. Let me go and take a look at that. Now, this is very interesting. So if I look at this analysis here on the Copula, and I know I'm jumping around, but the flow of this needs to make sense. The best fit Copula that we could find for this pair is what's known as the Clayton. This is based on the prices. I can also look at the Copula based on their returns, but I'm going to drop down here to prices. And these lines over here are the barriers. They're the borders. So if this red dot lands outside both of those borders, in other words, in this area down here somewhere, if that red dot or pinkish red dot lands somewhere there, there's an arbitrage opportunity. And this arbitrage opportunity is saying, hey, you might want to go long here on IOST and short on HBAR. That's what this is saying. If the red dot was up here, it would be the other way around. I'll talk about this more in up-and-coming videos, but notice the shape of this. It's sort of like this fan that spreads out as prices for X and Y go higher. Now, if you watch the video on Copulas, this will all make sense to you. If you've never heard of a Copula before, you're probably thinking, what the heck is this? But this is just a scatter plot of the prices on like a QQ plot. So we have the scatter plot of the prices here, and the prices are now between 0 to 1. That's what I mean by quantile. So 0 to 1, 0 to 1 on the X and Y. And we can see that based on where they usually are, that this red dot is now falling outside. But we also notice that the scatter of the prices when prices are really low are clumped more together. That means when the market's tanking or at the downside price-wise, then the dependency for these two assets is essentially increasing. The correlation for them it strengthens as prices are going lower. That's what this means. But irrespective of that, you can see here the data sort of clumping outside here. So this is very, very interesting to me. We're going to also change this to returns to see what that looks like. And you'll notice now a student T Copula better represents the data. So if this last return that we had, in other words, the change up or down on price, if the red dot was out here, it would mean that the way that that asset just behaved versus the other one was a bit outside of the norm. The probability of that happening was very low. That's based on 5%. If I change it to 1%, you'll notice that these gray lines are a lot more stringent. It would need to be all the way down here. So this is based on a 5% confidence. This is based on a 1% confidence. And over here, this is based on a 10% confidence, where I have a lot more leniency. So for those of you interested in Copulas and finding arbitrage opportunities with Copulas, This is going to be really cool. And it's probably my favorite thing right now on the platform. So here I'm going to jump back over here to our scanner to keep going through the information. So that's what this over here is telling you. And let's also take off that filter for Copula arbitrage opportunities. Here's the correlation as well. So this is the Copula-based correlation. So this is based on prices. Now there's a whole array of data points when it comes to correlation. So again, let me just go and analyze this in more detail. When I have correlation filtered on this chart, you'll notice I get a whole bunch of correlation metrics. On the left here, I have the returns. So this is different correlation metrics based on returns. The one that's commonly used is Pearson's, but it's the one that shouldn't be commonly used because it relies on the assumption that everything is linear and that or the dependency relationship is linear, and also that the distributions are elliptical, i.e. they are student T or they are Gaussian distributions. So that's not always a very useful metric. But Spearman's, Kendall's tau, this is a very useful one in terms of looking at the dependency, meaning how do the prices move up or down together? Do they typically follow the same pattern or not? This is the analysis that you'll find more useful here. So you can see here, we have this one here, the conditional chart based current correlation. And you'll see that the correlation changes over time. So you can actually see now, not just the correlation, but what is the correlation over time? This is actually calculated using volatility models, Garch models. And so we can actually get a rolling correlation over time for these two assets, up and down. And you can see when it goes negative, it'll change color. You can't really see it here on this chart. I can move this around. That's another improvement, by the way. The charts are much better. You can move them around. There's other tools as well for analyzing the charts too, here on the left. But that's just something to note. The charts may change color and you can draw on them and all sorts of funky things here as well. Anyway, I'm getting ahead of myself. Let's go back here to correlation. Also, we have our Copula statistics based on prices. So here's that 80.3% we saw earlier, what the best fitting Copula is. The ones that we're analyzing here right now are Gaussian, Student T, Clayton, and Gumbel, because they cover general bases pretty well. And everything bar the Gumbel Copula also gives us a defined calculation for this conditional probability here as well. So we can have these gray lines over there. And over here, we have our conditional probabilities as well. So if I go back here to my data and we just pull the latest of that, here's 97.5 and 9.9. So 97.5 and 9.9. Okay, perfect. Now note that for once, I've not mentioned cointegration at the start of a video. That's probably a good thing because there's so much more here. There's much more richness in the analysis, but cointegration is obviously still a very important metric. And therefore, because it's an important metric, we've included two totally different calculations for cointegration. One that relies on eigenvectors and eigenvalues and all sorts of complex analysis, known as the Johansen method for calculating cointegration, and the other one, Engel-Granger. So if I want one of these to be cointegrated, I can just select cointegration either, and one of these flags will be green, if not both. If I want both of them to be green, I could have that. If I just care about Engel-Granger, which is what the current platform has been using, I can use this Engel-Granger here as well. In addition to cointegration, we also have the Hurst exponent as well. So this is another way to gauge stationarity. And the lower the number, typically the better. But be careful with this because sometimes you can, say, have a dynamic spread, and I can now filter on, say, a Hurst ratio, which is less than 0.5. There'll be a lot of them. But actually, this looks really good. I was looking for something which could be a bit misleading, but actually the spread looks incredible. Let me just go to some other one over here. There we go. So you see here, the spread is just zigzagging a lot. This is one of the, I don't want to say drawbacks because it's information in and of itself when it comes to calculating a spread, but you can see that this is very dynamic. The spread is changing almost too quickly. It doesn't mean that the strategy won't be profitable. It just means that you sort of have this moving target, right? Because a dynamic spread means that the hedge ratio is not static. It's changing at each step in time, and that's estimated using our Kalman filter. So when you have something like that, it's going to show that the Hurst ratio is very mean reverting, i.e. less than 0.5. But if I go and change this to, say, a static spread, nothing gets returned. There are no results with a Hurst ratio less than 0.5. If I put less than 0.7, there's a few. Oh, and that's because I also have Engle-Granger filtered on here as well. So, okay, there's a few more if I go and include, whether they co-integrated or not. So just note that this Hurst is not always going to be very meaningful for you, but in some cases it is very meaningful. So if we take a look at some of these here, you can see this actually was a really good strategy to trade. It had a decent return and a very, very good Sharpe ratio here as well. So I'm going to remove that filter and let's move here onto half-life. Typically, you want the half-life to be, really, really small. You don't want a very long half-life because that means that the spread is going to take longer to revert back to its mean typically, or half its mean, I'm going to say. But that's what a half-life is essentially telling you, is how quick might it revert back to its mean. Now, we haven't even spoken about ECM analysis. So there's something known as speed of adjustment, which is not to do with the half-life right now, but I'm going to come back to talking about that in a moment as well. So we'll come back to talking about ECMs. The zero crosses, so this spread has crossed the zero mark here 17 times and has crossed 2 standard deviations 3 times. So that's happened more or less over here. So this can give you sort of an idea of how the spread is going up and down without even clicking on the chart. That's essentially what these crossings here are telling you. The next thing is volatility and risk. And there's a lot more that's come to the platform here. In fact, we can also run simulations. That's actually run automatically for you when you click on a pair. I'll show you that in a moment. But we have the long-term volatility of these 2 pairs over here, or these 2 assets, I should say. So if I go here, for example, to Wi-Fi and Alice. So Alice here is 112% annualized volatility and 79% for Wi-Fi. And this is important because it might dictate how you decide to go and allocate your capital based on risk. And then we also have the value at risk and the CVAR, the cumulative value at risk, here as well. So VAR and CVAR are very useful risk metrics because they tell you with, say, for example, here on this platform, 99% confidence on this one backtest, although this is just based on one backtest. I'll show you the simulation in a moment, that basically you are not going to have returns worse than 1% here, or 0.9% with 99% confidence from this one backtest. If it is worse than that, then it's likely to be a number of around 1.7%. This is a very crude and disgusting way, I think, of me explaining VAR and CVAR, but just think about this as how bad can it get? How bad can a trade get with this pair? And this is just based on one backtest. I'm going to show you how to look at this based on 1,000 backtests for this pair. So for example, let's say I wanted to know what the risk is here for this pair, BNB and CAS. And if I go and look at the chart on this, and I go down here, you'll see this number's crunching here, 60% of 1,000. So it's actually doing 1,000 different backtests. It's creating synthetic data based on the returns distributions in the Copula for this pair. And it's working out how bad can it really get with this pair. And here you can see that the VAR is around 5.76%. So my value at risk is 5.76% and my CVAR, cumulative value at risk, is 7.48%. So on the 1% chance that it gets worse than 5.76%, it's likely to be around 7.48%. You'll also note that this calculation down here, sometimes it might not run, and that can be due to the nature of the Copula. It's something I'm actually working on as an improvement in the background, but it is a useful thing to have. We've gone from just one single backtest of 3.6% and 4.1% respectively, down to these numbers, which actually give me a clearer idea based on more than just one backtest, looking at 1,000 of them. If you want more than 1,000 simulations, you can just go and change that here in the simulations or simulation runs as well. And then here to the right, we have our returns and our Sharpe ratio. Something to mention on returns. I've always said here on this current version of Crypto Wizards, just take these returns as directional, because we used a very different method for backtesting with less data, so not using the full range of data that we could get hold of. And this has changed dramatically. So you're going to see the returns numbers. Number one, they're going to look a lot more sensible. And you can change those to look more aggressive if you want, but that depends on certain assumptions, which I'm going to cover in other videos. But just note that the returns percentages are going to look very different and a lot more sensible for the current platform because we're bringing in other price assumptions into the mix, storing more data, and using a completely different algorithm. So for some of these pairs, like ridiculously good Sharpe ratios, right now I've got this sorted on highest Sharpe ratio. I could also sort it based on highest returns, for example. And the best, in fact, if I look at all strategies, and this is like, I don't know, 75 to 100,000 rows of backtests, the best I could come up with on Binance was a 444% return, which is far lower than some of the ones that we see here at the top of the current platform. And that's fine. That's absolutely okay. I want this number to be more conservative. I want it to be lower. I've been working on ways to improve that. And actually, the way we solved it is by putting in a much slower, more methodical and meticulous algorithm. And I say slower, you won't notice it. I thought it would make a difference and be too slow for people. And then there were some efficiency gains on not the hardware engineering, on the software engineering side that actually made it negligible. So you won't notice it, but there's a lot more running in the background for these backtests over here. So refreshing this one here, this has actually performed a really, really good return. This is a Copula-based strategy, it tells me there, and it's also highlighted in blue over here, 774% return. Again, the best performing strategy right now on Crypto Wizards, funnily enough, is a Copula strategy, not a spread-related one. But here we have some other strategies down here. You can see, because I haven't got strategy filtered out, you can see all the strategies down here. Interestingly, when I look at the spread-based strategies, some of them are profitable and some of them are not. And what's kind of useful here is I can sort of just click down all of these opportunities. You can see these are all green pretty much. And I can see where has this pair performed well across, all strategies or most other strategies. And so this can be a really useful way of doing it. Again, I haven't got this data updating live right now because I just want a quick scan. And it's literally not even a second. It's like split seconds to get that information. And this for me was really valuable. This tells me straight away, how has this pair performed across different statistical arbitrage strategies, really, really fast. The other thing I can do here, if I don't want to see the spread for this now, I just want to see the backtest, I can just look at the equity curve, or in fact, this is the net returns here, the portfolio returns for this over time. But if I want to go and see this in more detail, I can click again on my detailed analysis and I get more options. I can look at the entries. So this is telling me in purple with the arrow pointing, this way towards the right, a short trade was opened here and a long trade, or the short trade was closed here. A long trade was opened here and closed here. And so this is telling me where the actual trades took place. This here is then telling me what that did here to my portfolio over time. So my net returns. I can add in the individual assets performance as well. So let's remove net. This tells me which asset did well, which one didn't do well, and by how much. So that's pretty useful. And over here, this is defaulted right now to an OU. Here I can change this to the Copula strategy. And there you can see I get a very different picture of what's going on. Also notice that this pair in particular, what is this? HBAR and LTC. Look at the Copula here. The dependency is actually towards the upper end. So the dependency or correlation between these two assets improves when prices are both really high. So they move more alike when prices are actually higher. This is the Gumbel Copula. Notice because it's Gumbel right now, I don't have those gray lines showing me the borders, but it still gives me an idea of the dependency of this pair. Coming back to the backtesting over here, I also have an underwater drop down. So this is telling me from the best I got on my chart, how much did I then lose on my trade? The trade might not have been closed, but it's basically looking at peaks to troughs, so maximum drawdown sort of thing. And so you can see that over here, this is still green, it's still positive, but I could have closed up here and made a lot more money, and I didn't. And so my underwater here gets much worse. It goes down here. So also with the charts, I just should notice and I know I'm talking fast, I don't want this video to be too long. You can mess around with the charts over here. Something else that we've kept that's quite useful is you can change all the charts in one go with this top left item here at the top. I've tried using this on an iPad right now. It doesn't work great. I'm working on that. Mobile phone as well. You'll just sort of see the charts. It's quite tricky to move everything around and play with the charts. In fact, you can't tap the charts on iPhone or iPad at the moment. Again, I hope to improve that. But this is really a desktop application. It's meant for desktop analysis right now. I'm thinking of putting in like a mobile-only application at some point. Right, let's just go and look at a standard static spread strategy. Let's take a look at this one, for example, any one of these, this one will do. And let's go and do some analysis. So first of all, a big change has happened, and I didn't want to make this change. I was forced to by adding in new types of spread analysis onto the platform. But we've inverted the spreads. And I would say we've actually corrected the inversion, because before what was up is now down and what was down is now up. What do I mean by that? Well, when the spread here is low, when it's red, it means go long on red. So it means go long on this pinky one here. When it's blue, it means go long on blue. So when it's red, go long on red and go short on blue. When it's blue, go long on blue and go short on red, which is the other way around. So it means when it's low, you're actually going long on ticker 2, not ticker 1. And so this is a big change. It's going to probably frustrate a lot of people. It definitely frustrated me. So I apologize for that, but I can tell you now it was for the right reasons. Let's go and talk about the OU spread, the OU process now for a moment. So actually here, I'm going to filter on OU. And in fact, I'm going to filter on OU optimal. Let's filter on correlation being high as well. I like this. I like this mixture of filters. So an OU that has an optimal entry and exit, that's what this optimal means. I'll show you more about that in a minute. And where the prices are highly correlated. I think these are very, very useful. I could also put in co-integration here as well. So yeah, these are also co-integrated. So if I look at one of these, wow, yes, this is a very nice looking spread. So I like that one. I mean, these spreads look fantastic. Like it's just awesome to see and to get that pretty quickly. So I'm enjoying, even now, I'm just enjoying having this. Let's go here and take a look at the spread. So optimal means these green numbers up here are available. And this is looking at what's known as optimal entry and exit. So over here, it's saying the optimal entry is around negative 1.29. So that's probably around here somewhere. And the optimal exit 2.06 is around up here. And this is excluding trading costs. So not the backtest, but I'm not saying the backtest is excluding trading costs. This is just for where the optimal entry and exit is. It's ignoring the idea of trading costs. If you had trading costs baked in, they'd probably be around here and here. Okay, so just bear that in mind. It narrows down a bit. But this is saying the optimal place to get into this spread right now is go long here on the spread and go short up here on the spread. So right now it's saying do nothing. But if this number went down here, it would say go long on the spread or short up here. Now, the calculation of that is really complex, and the optimal entry and exit will only show, this will only show when it can be calculated. And so here it could be calculated, meaning that because it could be calculated, it's probably a quite nice looking spread. So this in and of itself, having this available, which you'll see it's not always available, is useful information. And then I have a whole bunch of metrics here to do with an OU process. I'll cover that in subsequent videos, but this is essentially telling me, for example, this number over here, this is telling me for every dollar I put in APE USDT, how much might I want to put here in band USDT. And so this is actually a calculation that's done for us. For every $1, I might want to put 37 cents in the other one. I'm not saying do that. I'm saying this is what information is available to you. Talking about information that's available, let's actually go ahead and look at some of this other data here we haven't really spoken about. So we've got this conditional correlation. This shows me the correlation over time. I also have the beta as well. Now this beta, it gives me the long-term beta, which is 0.6. And I think here, if I look up here, yeah, long-term beta, there you go, 0.6. It's up here as well. But the current beta is 0.83. And this beta is essentially saying for every point, say, APE moves, how much will band move in relation to that? That's what this beta here is telling me. So there's the betas. And then I also have volatilities. So this is actually showing me, let me get rid of APE. You can see this massive spike up here for APE. Let me get rid of that volatility there. You can see the volatility here over time for band. If I just look at APE, here's APE over time. Again, we have this massive spike up there as well, which sort of skews the data. And then I can add a zero item over here. So you'll notice you can't really see it, but there's this zero I can click on. It's just sort of this hidden trick. If I do that, it shows me zero on the chart as well. So I can see how high above zero do these volatilities or annualized volatilities start. And here I've got the volatility metrics here on the left as well. So a number near 1 will tell you that volatility persists. So when it clusters, it sort of sticks. So when, for example, ape is very volatile, it goes through a volatile hit, how long will that typically persist for? Will it persist for quite a while? These numbers tell me that. And actually, for example, over here, band is not very persistent at all, I would say. And then how does it relate to market shocks? So how do the market shocks or the random impacts in the process, or what's being modeled here in the Garch model? If you're not sure what a Garch is, again, I did a video recently on that. This will tell you how it reacts to those market shocks and also the asymmetry. So does volatility change on the downside versus the upside? Is the volatility different? Now, again, we'll go through volatility in detail. I don't want to go over that right now. I want to plan that video out and do a thorough job of explaining that to you in a separate video. So there we go. That is volatility. And now we have something really interesting. We have this error correction model. This is not something you will see out there in the wild very often. And in fact, you will see it, and you'll see it for like a static sort of armor-based process. So just looking at a typical spread. But this is a dynamic ECM. So here I'm looking at using state space models to basically estimate how one asset reacts to the other over time. And this is very useful, I find, very useful for identifying where a shift in the market has taken place. So a market regime change has happened. What do I mean by all of this? So over here on the left, I've got my sort of static ECM. So this is just a standard error correction model. What this means is generally how has one asset reacted to another asset. And then the dynamic one is how is it currently doing it? And so you'll see the numbers are very different. Now, where you see a green number, this means that the p-value is very low, meaning that this number is statistically likely not to be a fluke. This is how I look at it. You can look at it how you want to. If this number's not green up here in this top section, so this section's different, you won't ever really see numbers green down here. But up here in this section, if this number's not green, I ignore it. I don't look at it at all. But if the number's green, it means there is a statistically significant number here. And this means that band USDT, so ape USDT, reacts to the change in the last time period, the lag 1 of band USDT by 0.13. And so this is telling me that using that information, I can actually forecast based on the current time period I'm at here, and this is known as an impulse response. What if there were no more market shocks? What would the spread do? Would it go up or down? And this is actually taking into account all available information. But that's what this here is telling me. I don't find this here very useful. It's there just for a nice to have. Like it sort of summarizes all information for me. What I think is very useful is this dynamic ECM. And this is here based on Y being the dependent variable. So this band USDT, I can also look at it based on X. And this would look the same if I flip these two assets around in terms of X and Y. But this just saves you doing that. So how did they relate to one another? An ECM analysis is only really useful, in my opinion, if the spread is stationary. Likely if it's co-integrated. So if they're not co-integrated, a warning will pop up here that, hey, this ECM analysis might not be very useful. One thing I can do is get rid of those and just look at how these assets relate to the spread itself. So how the price changes based on what the spread itself was doing. And you'll see here, the spread has basically no impact on these two assets, but that's not always the case. This will tell you that. And so the amount, it's almost like analysis paralysis at this point. But I'd never seen this done before. I was having a lot of fun with state space models, and I wanted to build this into the platform. And when I did, I realized it actually works, and it does help you spot regime shifts. And one of the things we can do here as well is just cut off the beginning of that. So you'll notice the beginning is always a bit zigzaggy because the model has to basically learn what's going on. So if I cut that off, then I can actually see a cleaner view of what's going on over here. So that's my error correction model. Now, because there's this error correction model, and because we have correlation over time, it's like, well, it would be nice to have seen co-integration over time, but that doesn't really make sense. I tried it in the last platform. So in this platform here, I did try doing something like that, where down here, where you do a backtest, you could sort of look at co-integration and it would look at like a rolling co-integration. it's not very good. What probably makes more sense is to look at, if we have this ECM, how are the assets deviating? How are the prices actually deviating from the model? And if we go and do that and scale it between -1 and +1, so they're deviating up or is it deviating down, this will tell you how strong is the deviation from what's been modeled. And what's been modeled in this case is a co-integrated process. So this spread here, according to the Engel-Granger process and how I've modeled it here, is co-integrated. This here is telling you how closely it's following that co-integration. So if it's near 0 here, like around this period, it's following that co-integrated relationship quite well. Here it's not. And so one could look at this and go, okay, so this is really doing badly at following its ARMA model here and its error correction model. Maybe it's going to revert back. And so this is something that I've really not tested enough of. In machine learning, it had so-so results, but at least it gives you an idea of how is this asset over time performing against its co-integrated relationship. If this sort of hovers around 0, then that's telling you that this thing is, really consistently moving with how it's been modeled. And that, I think, I couldn't work out how to do it. I think we've now worked out how to get that view. And that's what this ECM strength here is really showing you. So I think in terms of the zscore tool, this video has been way longer than I wanted, and there's still stuff I need to take you through, so I'm going to carry on. But in terms of the zscore tool, those are the main takeaways. If you want to set alerts, just click on the bell up here or on the scanner tab. You can click on the bell and do that over here. So I can go ahead and set my alert, and there you go, my alert has been set. Now just note with alerts, a couple things. There's a lot more that you can be alerted for, and you can also now set more alerts. But because of that, and this is the downside, because of that, there is a breaking change, and that breaking change is the alerts you currently have set up are going to be wiped out. Yeah, I'm sorry about that, but they're going to be wiped out as of Monday. So when Monday rolls over, we need to put in the new way of setting alerts with all these, new spread calculations, all of that. And so when we do that, just note your alerts are going to disappear and you will have to reset them. The good news is you can set much better alerts. And because the spread is now normalized, it is essentially a z-score calculation. You might not have to tweak your numbers so often for your alerts and resetting them and all of that sort of thing. So that was a request that came in as well. Thank you for that. So because of all of that, we have had to go and make some breaking changes. But there you go. You can do more with alerts. And the same here with simulating a trade. You can click on this diamond. This hasn't changed at all. I can go and now place a trade for this. It's not a real live trade. This is just a research platform. And it's also a research platform for personal use. So just note though, I can go and do that. And when I do, I can go here to my trades and there they are over here. I can either delete them if I don't want them anymore, export them to Excel, whatever. So all of that is pretty much the same. Here's my alerts that I just set up and I can go and manage those here too. Still using Telegram at the moment for receiving those alerts. Now up here, we have some other items. We had XTrader before, but XTrader now, because of GPT-4, is pretty much redundant. However, we do have a need to get data. And I got frustrated with the desktop application idea. First, I thought that would be really good. And I was like, it's actually annoying. I'd rather just be online and be able to get data. And so here we've added this data extraction feature here, but angled it so that you can put in statistical arbitrage type metrics where it makes sense to do so as a column. So where that metric might change for each time step. So here I can select whatever assets I want and what columns I want. Let's say I don't want volume and I don't care about high and low. Maybe I just want the open and the close prices. And I want it for, 365 periods. And I want 4-hour data, right? So this will go and run that for me. And maybe I want the OU spread, the dynamic, the correlation, and the beta. I want all of those added here as well. So that's now all there. I can just go and export that to Excel. And there we go. I can go and open up this here. I don't have Excel open at the moment, so I've just got to wait for that to pop open. And here is my data over here. So now I have all of that information here in Excel. I can put it through my own ML models, put it into GPT-4, ask it to run some XGBoost for me, whatever it is you want to do. I use this all the time. I pull data all the time. It's probably the feature that I use the most often is this data tool. So even though it's a simple thing, I find it saves me a lot of time. In terms of data and also the analysis, and again, I know I'm jumping around, there's actually so much more than I thought to go through. There is a lot to go through, so my apologies. On the scanner, you can do daily and hourly as before. And again, there's also stocks now in here too. So in fact, what I'm going to do is restore everything. And I'm going to select down here, stocks and other. I didn't have to do that, by the way. It's just because I wanted to clear all these filters. And now that I've got stocks and other, this is basically showing me ETFs and stocks, so pre-scan results for that. So now we have stocks as well. We had Forex before, so that's still here. Stocks and Forex is just daily. So if I go to hourly, I'll see nothing for that at the moment. Now just note here, the returns for stocks and Forex are much lower. The Sharpe ratios, everything versus crypto, same as before, same as we had with the prior platform over here, although we didn't have stocks here before. We just had Forex here. Although there really are no pre-scan results here for stocks. But just note, again, the returns here are pretty low for Forex. Same thing. The returns here are much lower. Now, if you want to see aggressive returns and Sharpe ratios, you can go here to Preferences. And where it has here metric standard, you can put this on aggressive. So now when I go and I look at one of these and refresh the data, it's going to jump to more of an aggressive, for example, Sharpe ratio. And this is now also putting live data. Sorry, I wasn't putting live before. It's more aggressive because when you calculate a Sharpe ratio, you can decide to include the periods that you weren't trading, i.e. I wasn't in a long or short position, which we do by default. But if you exclude those and you just want to say, no, I just care about the periods I'm trading because my capital is always deployed, I'm always in a trade, then you can change that. And your Sharpe ratios start to look, they get ridiculous. So what I'm going to do is just shift that back. And some people prefer that. They prefer that for the analysis they're doing. But I'm going to just shift that here to standard. Another thing we have here, by the way, I should mention is capital weightings. Risk reduction means that it will automatically adjust how much or what percent of your capital is allocated to an asset based on how volatile that asset is. If I have it as even, it'll just do 50-50. So what do I mean by that? Actually, when I very quickly come back here and I go down here to my, where is it? Over here, yes. My capital weighting, this is telling me how much capital is weighted to one asset or the other. Same thing as we had before, so you can adjust how much capital you're putting there. If you put the default as even, it'll just default that to 50-50 for you on every refresh. Of course, when you hit restore, it'll reset all of that again. And then here, for my spread, for my rolling z-score, what are my entries and exits? And just remember, we've changed what's X and what's Y. So this is based on X, Y will be the opposite. X is the first ticker, Y is the second ticker. And Copula here, we do it based on 5%, but if you want it to be based on 1%, you could make this 1 and this 99, for example. So that's something to note too. So we're able to get our data here easily. We also have our download. So if any Excel models I'm putting together, like this Kelly criterion one we had before, I get asked for that a lot. All of that stuff is just here. It's being populated and included here. And so as more Excel models get developed, I'm just going to keep adding them there. I think it's easier for everyone that way. And the courses, no change here, although courses are coming. New courses are being built. And so some of these will be upgraded and replaced entirely. They're aged. More to come on that. A lot of work to do this year on course material and upgraded everything. And code as well. So instead of you having to figure out logging into Code Raiders and all that, we've been able to spend some time to actually just pipe the trading code here into Crypto Wizards. So instead of having to use Code Raiders to get, trading related code, which is really what Crypto Wizards is about here, it's trading related stuff, statistical arbitrage, flash loan, smart contracts, all of that stuff. It'll just be here. Submarine Sense, you can just go here and click on the code package and it'll take you over to that code package and give you a full walkthrough on how to go and get that code running. There's also a video walkthrough here at the top as well, walking you through how to get that code up and running. So all of that has been provided here as well. Now, like I said at the start, these changes are not in place yet. They're coming this Monday. So right now, just bear with, you've still got this platform. It's been fine up until now. You'll be okay for one more week. But this is what's to come. One other thing to note here very quickly is the spread. It's mainly using log prices to calculate the spread. If that presents a negative hedge ratio, we then actually revert to using absolute prices. It doesn't tell you which it's used, but the spread is, just think of it as the spread's always calculated using the optimal prices here as well. So not only is it inverted, but it's also been optimized based on whether to use log prices or not. I trust that this video has been useful for you and that you'll have a lot of fun playing around with the tool and doing some really in-depth analysis. I hope you enjoyed the video. Until the next one, take care and talk soon.